Today we are reviewing Smart Money Concepts, also known as SMC, by LuxAlgo. This is a TradingView indicator designed to automatically mark up the chart using popular smart money concept ideas. It is a free and open source script, which is important because we are not limited to only judging what we see visually on the chart. We can also inspect how the logic is actually built. The full name of the indicator is Smart Money Concepts, LuxAlgo, and it was created by LuxAlgo, one of the more well-known TradingView creators. LuxAlgo has published many indicators, so this is not a small, unknown script. This is one of the more popular SMC-style indicators on TradingView. Now, before we go deeper, we need to briefly explain what Smart Money Concepts actually means. SMC is a trading framework based on market structure, liquidity, and price action. The basic idea is that price often moves toward areas where orders are likely sitting. For example, above previous highs, below previous lows, around equal highs and equal lows, or near obvious support and resistance areas. In simple terms, instead of just asking, is price going up or down, SMC traders ask, where is liquidity sitting? Where are traders likely to have their stop losses? Has price broken structure? Did price sweep a high or low? And is price returning to an important zone before continuing or reversing? That is the general theory. But we also need to be careful. Just because an indicator marks an order block or a liquidity zone does not prove that banks or institutions actually placed orders there. Most of these concepts are inferred from price action. According to the authors, the indicator attempts to mark internal structure, swing structure, break of structure, change of character, order blocks, fair value gaps, equal highs, equal lows, and premium and discount zones. So this indicator is not a basic moving average, oscillator, or simple buy and sell signal tool. It is not a strategy. It is not a full backtester. It is best described as a market structure and price action overlay indicator. What it attempts to do is take a discretionary trading framework and turn it into visual chart labels, zones, and alerts. The indicator appears to target price action traders, especially traders interested in smart money concepts, ICT-style trading, liquidity sweeps, structure shifts, and institutional-style chart analysis. It does not appear to be built for only one market. You could apply it to Forex, crypto, stocks, indices, gold, or other TradingView markets. The time frame also seems flexible. But whether it works equally well across different markets and time frames, and whether it actually provides any trading edge, is what we are going to examine next. Before we touch the code, let's first look at the indicator the same way most traders would see it when they add it to a TradingView chart. And visually, the first impression is that this is a very detailed indicator. It is not a simple oscillator. It is not just one moving average, and it is not a basic buy and sell arrow tool. This indicator draws directly on the price chart. It adds market structure labels, break of structure labels, change of character labels, order block zones, equal highs and equal lows, fair value gap areas, and other price action levels. So immediately, the chart looks much more structured. From a visual design perspective, I would say the indicator looks professional. The labels are small, the zones are transparent, and the chart does not look completely random. The different elements are visually separated enough that once you understand the terminology, you can follow what the indicator is trying to show. But the important question is, what do you actually do with that information? That is where the first weakness appears. The indicator gives a lot of context, but it does not automatically give a complete trade decision. It does not clearly say, enter here, stop loss here, target here, and this setup has this probability. Instead, it gives you market structure information and expects you to interpret it. That is not necessarily a bad thing. In fact, for a discretionary price action trader, that may be exactly what they want. But it means we should not treat the indicator as a mechanical signal system. It is more of a chart markup assistant. Now, in terms of readability, the indicator looks better when the market is moving cleanly. For example, when price is trending strongly, the labels make the chart look very logical. But in choppy or sideways conditions, the chart can become much harder to read. You may get several small structure changes close together, with internal labels appearing inside a larger range. That can create noise, especially on lower time frames. Another thing to mention is hindsight. Visually, this indicator can look very convincing after the move has already happened, but real trading does not happen with the full chart already printed. The real question is whether those labels appear early enough to be useful, whether they stay fixed after appearing, and whether they help before the move, not only after the move. Another visual concern is how well this plays with other indicators. Because this script already draws a lot of information directly on the price chart, it can quickly become crowded if you add more tools on top of it. If you add moving averages, support and resistance zones, volume indicators, another signal indicator, or another market structure tool, the chart may become difficult to read. So this is probably the type of indicator you would want to use either by itself or with only a small number of supporting tools. It is not ideal for a chart that is already heavily loaded with indicators. The next step is to look at how the indicator actually defines these labels in the code, because that is where we can separate useful structure from attractive hindsight markup. Now that we have seen how the indicator looks visually, the next step is to inspect the code. This is where we can start separating appearance from actual logic. The code is written in PineScript version 5. It uses the indicator function, not the strategy function. So right away, this is not a TradingView strategy. It does not contain strategy entries. It does not contain strategy exits. It does not contain a built-in backtest. And it does not contain realistic stop-loss or take-profit execution logic available in live trading. This indicator is a visual chart markup tool, not a full trading system. The first thing I always check in a PineScript indicator is whether it uses request.security. In this script, it does. Request.security is not automatically bad. It is commonly used to request higher time frame data. But the important detail is how it is used, and especially whether it uses lookahead. In this code, we do see lookahead equals barmerge.lookahead_on. That is one of the most important things to notice in the entire script. The script uses lookahead on in two areas. One area is for fair value gaps. The other area is for daily, weekly, and monthly previous high and low levels. For the previous high and low levels, I am less concerned. Those previous levels are normally already known once the new higher time frame period begins. But the fair value gap section is more concerning. In the fair value gap function, the script requests higher time frame values, including current high, current low, and current time, while using lookahead on. That can be a red flag, especially when the fair value gap time frame is higher than the chart time frame. The reason is simple. On historical lower time frame candles, lookahead on can make higher time frame candle information appear earlier than it would have been fully known in real time. In other words, a historical chart may show a fair value gap as if it was available cleanly at that point, even though live trading may not have had the same confirmed information yet. The next thing to check is pivot logic. This script does not directly use the built-in Pine functions ta.pivothigh or ta.pivotlow, but it does use its own pivot-style structure detection. The code checks whether a high or low from several bars ago became a new structure point. Swing structure uses a default length of 50 bars. This means structure points are confirmed late. However, it is normal for pivot-style logic, but it can make historical charts look cleaner than real-time trading would have felt. For example, if a swing point needs 50 bars to be confirmed, then the chart may later show the structure point on the original candle. But in real time, you did not know that point was confirmed on that original candle. You only knew it after the required confirmation bars had passed. Now let's talk about break of structure and change of character. The script detects these when price closes across a stored pivot level. For bullish structure, it uses a crossover of close above the pivot level. For bearish structure, it uses a cross-under of close below the pivot level. That is generally better than using only high or low spikes because it is based on the close crossing the level. However, there is no explicit barstate.isConfirmed condition around these signals. On historical candles, that may look clean, but on a live candle, the close value updates while the candle is still forming. That means a condition may trigger intra-bar if price crosses the level before the candle has closed. For safer live alerts, the user should set alerts to once per bar close. Now for order blocks. The script identifies order blocks after structure events and stores zones based on prior candles. These order blocks can then be drawn as boxes on the chart. But an order block appearing historically does not mean that the trader knew the zone was valid from the first candle of the box. In many cases, the zone is only identified after a structure break confirms it. So again, there is a difference between where the zone is drawn and when the zone became known.
Another important point is chart type. This indicator uses the chart's open, high, low, and close values directly. That means if you apply it to a Heikin-Ashi chart, it will use Heikin-Ashi prices. If you apply it to another synthetic chart type, it will use that synthetic chart's values. This matters a lot. Market structure, order blocks, fair value gaps, highs, lows, and liquidity zones can all change when the candle data changes.
So, if you want this indicator to reflect real tradable market prices, it should be used on normal candles or bars, not Heikin-Ashi or synthetic chart types. So, what is the overall code review verdict? So, from a code perspective, this is a serious and well-built visual indicator, but it should not be treated as a non-repainting trading system. It is better understood as a market structure mapping tool with delayed confirmations and some dynamic elements. Now let's quickly go through the settings. A lot of the settings in this indicator are simply visual. They control colors, label styles, line styles, and whether certain features are shown or hidden. Those settings are useful for cleaning up the chart, but most of them do not create a trading edge by themselves. The settings that actually matter are the ones that change how the indicator behaves. The first important setting is mode. Historical mode keeps old labels, lines, and zones on the chart. Present mode deletes older drawings when new ones appear. This can completely change how the indicator feels visually. Historical mode is better for reviewing past behavior, but it can make the chart look very convincing in hindsight. Present mode is cleaner for live use, but it removes historical context. The next important setting is swing length. This controls how sensitive the larger swing structure is. A higher swing length gives cleaner structure, but confirms later. A lower swing length reacts faster, but creates more noise. The confluence filter is also worth mentioning. This tries to filter weaker internal structure breaks based on candle shape. Order block filter is another important setting. It controls how the script handles high volatility candles when creating order blocks. This matters because order block zones are not just drawn from the obvious candle. The script applies a volatility filter, and that can affect the final zone boundaries. Order block mitigation decides when an order block is considered broken. If you choose close, price must close beyond the zone. If you choose high-low, even a wick through the zone can count. Close is stricter. High-low is more sensitive. Equal high and equal low settings also matter. Bars confirmation controls how many bars are needed before an equal high or equal low is confirmed. Threshold controls how close two highs or lows need to be before they count as equal. Lower threshold means fewer, stricter liquidity levels. Higher threshold means more detections, but also more possible noise. Finally, the fair value gap settings. Auto threshold filters out smaller gaps. Fair value gap timeframe allows gaps to come from another timeframe. This is useful, but it is also the area where the code uses request.security with lookahead on, as we discussed in the previous section. Now let's talk about the practical use case. How should someone actually use this indicator in real trading? The first thing to make very clear is this. This indicator should not be treated as a standalone entry system. It should not be treated as proof of institutional activity. And it should not be treated as proof that real liquidity exists at a specific level.
This is one of the biggest issues with smart money concept indicators in general. They use terms like liquidity, order blocks, smart money, and institutional zones. But the indicator is not actually reading real order flow. It does not have access to the real order book. It does not know where hidden orders are sitting. It does not know where banks or institutions placed orders. It does not know true cross-market liquidity. And it does not know whether a large player actually participated at a specific candle. This becomes even more important on instruments that are not fully centralized. For example, in spot Forex, there is no single centralized exchange that shows all global liquidity. With gold CFDs, the chart depends on the broker or data provider. With crypto, liquidity can be spread across many venues. So when this indicator marks liquidity, it is not measuring liquidity directly. It is inferring possible liquidity, levels, and highs from price structure. So what is the realistic use case? The best use of this indicator is as a chart markup assistant. It can help you quickly see where price reacted in the past. It can help you identify previous highs and lows. It can highlight equal highs and equal lows. It can show where the script thinks structure changed. And it can point out zones that may be worth watching again later. In other words, the indicator can help you find areas of interest. But it should not make the trading decision for you. On screen, you can see how I scored it. I am not scoring this as a profitability system. I am scoring it as a review tool based on things like transparency, visual quality, code safety, repaint and hindsight risk, practical usefulness, and how realistic the claims are. My overall rating is around 7 out of 10 as a market structure and chart markup tool. If you found this review useful, leave a like on the video. If you disagree with the score, or if you use this indicator differently, let me know in the comments. Also, if there is another TradingView indicator you want me to audit next, drop the name in the comments. Subscribe if you want more indicator reviews, where we look beyond the marketing, inspect the code, and separate useful tools from chart decoration. Thanks for watching, and I'll see you in the next review.